Ever wonder who actually signs the check for a $2 billion suspension bridge? If you or I take out a mortgage and stop paying, the bank's solution is simple. They take the house and sell it to someone else. But if the developer of a massive public toll bridge goes bankrupt, the bank cannot exactly repossess thousands of tons of concrete and sell it on the open market. Because they can't sell the bridge itself, lenders look at the money left over in the register after all the daily bills, like electricity and maintenance, are paid. This pile of cash is the project's lifeblood. Think of it as the project's allowance that is specifically reserved to pay back the loan. Since the bank's repayment relies entirely on those future tolls, they demand absolute proof that the money will be there. To get that proof, they put the idea through a rigorous, multi-stage testing process called the Project Evaluation Framework. Before anyone pours a single drop of concrete, developers must pass Stage 1, the initial screening. Think of this as a quick pass-fail test to verify the idea fits the local needs and makes basic financial sense. If it passes, the project moves to Stage 2, detailed feasibility. First, they have to prove market demand. For our bridge, that means showing hard data that there are enough daily commuters willing to pay the toll to keep the project running. Next comes the technical feasibility check. The developers have to show they have the proper materials and the exact engineering designs to physically build this massive structure over a specific, complex riverbed. Then they run a legal and regulatory check to confirm the project has all the necessary government licenses and environmental approvals to move forward without being shut down by the courts. Passing these checks proves to the bank that the bridge can physically be built and that people will actually use it once it's finished. Even a brilliant plan faces the real world. In Stage 3, the lenders look for unpredictable risks, like a sudden spike in the price of steel or extreme weather that halts construction for months. Banks refuse to absorb those risks. If a storm washes away a month of work, the lender will not foot the bill. They demand strict protections to safeguard their investment. Developers provide protections using risk fixers. Fixed-price contracts lock in construction costs. Insurance covers unexpected weather damage, and government guarantees secure steady cash flow. These tools take a vulnerable idea and turn it into a secure, risk-adjusted project that a bank feels comfortable financing. Stage 4 maps the project's financial life story. This line chart traces cash flows, starting with the construction phase. Huge bills arrive, plunging the project into deep debt. Eventually, the bridge opens. Commuters pay tolls, and the line climbs into the green operation phase. But a specific chunk of that profit is immediately set aside to repay the loan. Finally, we calculate the residual value of the project's assets once retired. Mapping this out proves to the bank exactly when the project will climb out of the red and successfully finish paying them back. In Stage 5, the bank uses math to grade the project. They check if the future toll profits are actually worth the massive spending they are doing today, and they count exactly how many years it will take to get every cent of their investment back. The ultimate test is the debt service coverage ratio. Imagine a scale balancing the debt owed against the toll cash available. Banks won't accept a perfectly balanced scale. If commuters stay home, a 1-to-1 ratio means missed payments. They demand a buffer, often requiring 50% more cash coming in than what is owed, ensuring they get paid even on a bad day. Achieving that strong safety margin is what finally makes a project bankable, giving the lenders the confidence to say yes. To see how this chain works, imagine when a risk is ignored. A structural flaw forces an emergency shutdown. Traffic comes to a complete halt. No traffic means no toll revenue. That drop in cash destroys the safety margin. The scales tip the wrong way, the debt cannot be paid, and the bank would have denied the loan on day one. But by using insurance and contracts to handle those risks up front, the cash stays stable. That stable cash guarantees the bank gets paid, which keeps the whole project standing. The evaluation process must be integrated because the bridge only gets funded when risk management and the math of the cash flows perfectly align. Next time you drive over a massive mega project, remember that you are crossing more than just concrete and steel. You are driving on a bridge built on a foundation of mitigated risk and reliable cash flow.